Hello, welcome to our channel. Global markets focused on the Fed's interest rate decision in the new week. Global markets focused on the monetary policy decisions of the U.S. Federal Reserve, Fed, which will be announced on Wednesday this week, after the inflation announced last week exceeded expectations. Inflation, which continues its upward trend on a global scale, especially in the USA, continues to be influential on pricing in the markets. The Consumer Price Index, CPI, increased by 1% month-on-month in May, showing the highest increase since December 1981 with 8.6% year-on-year, according to data released in the US on Friday. Contrary to expectations, inflation continued to rise, which lowered the risk appetite in the markets, fearing that the Fed's aggressive hawkish policies might continue for longer than anticipated. While the said development increased the selling pressure in the bond markets, the reversal of the yield curve in some assets strengthened the fears of recession. Accordingly, while the U.S. 2-year bond yield reached its highest level since 2007 with 3.20%, the yield curve in the 3, 5, 10 and 30-year U.S. bond yields started to price the recession risk. On the other hand, the possibility of a 75 basis point policy rate hike, which Fed officials previously described as improbable, was included in the pricing again. At the meeting to be held in the money markets this week, it was priced that the Fed would increase interest rates by 75 basis points to control inflation with a 25% probability, while the probability of a 75 basis point increase in interest rates increased to 53% at the meeting to be held in July. Although the possibility that the new type of coronavirus, COVID-19 epidemic in China may not be fully under control has suppressed oil prices, the average price of gasoline in the USA reached an all-time high with $5 per gallon, about 3.8 liters. With these developments, the S&P 500 index fell by 2.91%, the Nasdaq index by 3.52% and the Dow Jones index by 2.73% in the New York stock market on Friday. Index futures contracts in the USA started the new week with sellers. While the European Central Bank, ECB, did not change the policy rate last week in line with the expectations, this week the eyes in the region turned to the monetary policy decisions of the Bank of England, BO. While it is considered certain that the BO will increase interest rates by 25 basis points at the meeting on Thursday, the possibility of a higher rate hike by the bank is also priced in. On the other hand, U.S. inflation, which exceeded expectations on Friday, caused bond yields to rise rapidly in Europe, while Germany's 10-year bond yield rose to 1.52%, the highest level since April 2014. While ECB and BO officials stated that macroeconomic data will have an important place in the course of monetary policy in their verbal guidance, this week's intense data calendar in the region draws attention. While these developments deepened the selling pressure in the regional equity markets, on Friday, the DAX 30 index was 3.08% in Germany, the FTSE 100 index was 2.12% in the UK, the CAC 40 index was 2.69% in France and the FTSE MIB 30 index in Italy. The index lost 5.17%. Index futures contracts in Europe started the new week with a decrease as well. While Asian stock markets carried the seller's course on Friday into the new week, parallel to the global markets, the news flow that will negatively affect the already low risk appetite continues. While some measures are being implemented again after the increasing COVID-19 cases in China, the rising tension between China and the USA over Taiwan increases the risks in the markets. Ahead of the monetary policy decisions of the Bank of Japan, BOJ, on Friday, the dollar-yen parity rose to 135.16, the highest level since January 2002, due to concerns that the Fed will continue its aggressive policies. BOJ Chairman Haruhiko Kuroda, in his statement on the subject, stated that they do not want the sharp depreciation of the Japanese yen, and that they closely monitor the movements in the exchange rate and its impact on the economy. Noting that the Japanese economy is still under the influence of the COVID-19 epidemic, Kuroda said that they will continue to support the economy with loose monetary policy to ensure an increase in wages. After the increased volatility in the South Korean won, it was stated that the developments were followed closely in the statements made by the Ministry of Finance and the central bank. With these developments, the Nikkei 225 index in Japan is 2.94%, the Shanghai Composite Index in China is 1.2%, the Hang Seng Index in Hong Kong is 3.24% and the Kospi Index in South Korea is 3.3%. Lost. Please subscribe and follow our channel. See you in our next videos.